Everyone. Thanks for joining us across the world. And I think you got very lucky there. This was a sneak preview, first glance at our new disaster risk financing video. I hope you found it inspiring. And indeed, today we're hopefully going to inspire you even more to focus on disaster risk financing for agriculture. Now onto module 7, macro meso risk transfer for agriculture. As usual, I'm joined by some very, very experienced speakers with me today. We've got Galile Ndlovu, who's going to take you through some of the key concepts and principles of macro meso level risk transfer. We've got Christina Stefan, who's going to take you through a case study from the DRC. We've got Fatima Dicko, who's going to take you through a case study from Burkina. And then we've got Melvin Chirume, who's going to talk to you about some of the work that ARC do in the area of macro risk transfer. Next slide, please, Penny. Now, I know many of you have been on a number of these sessions so far, but please bear with me while I do a little bit of housekeeping. So today, I don't think there's too much to worry about. Our speakers have you in good hands, but please do just try to engage in the polls that we'll be doing throughout the session, and also please feel free to fire your questions and questions for the question and answer session in the chat box at any point during the session, and we'll have ample time at the end to talk through those in some detail. Next slide, please. So we want to acknowledge that this is a big time commitment to sign into all of these, and I know that you're all very, very busy. And we have covered a lot of information, so we wanted to make sure that you can say, look, I've spent 16 hours during these sessions, I've learned a lot about disaster risk financing. How can I represent to my colleagues that this is something that I now know a lot about? So if you've been to four of the initial 5 webinar sessions, then you will have received a participation certificate if you were able to complete a short survey or quiz. For those of you that have been able to attend the majority of the sessions throughout, noting that our next session will be our final one, then please do respond to the link that will be sent out to you, where you'll be asked a few questions on disaster risk financing, a few questions on how we did during this session, and then you'll be presented with a certificate at the end of that as well. Next slide, please. So we have come a long way. We started off with an introduction to disaster risk financing and disaster risk financing for agriculture. Then we looked at agriculture risk management more broadly and how risk financing can sit as a part of that. Some of the agriculture finance instruments that can support risk management as well as productivity. And then we talked about, well, how do we actually structure a financial protection scheme, and how do we implement it, and how do we make sure that that's good quality? And then in the business end of the series, we've been running different deep dive sessions into specific disaster risk financing instruments. So last session was on agricultural insurance, sold directly to individual farmers. This session we're looking more into macro and meso level risk transfer. So this is insurance and other financial instruments that transfer risk away from organizations, businesses, governments, in order for them to support individual farmers themselves. And the next session will be looking at how governments can retain risk within their financial systems in order to support agricultural objectives and vulnerable populations. Next slide, please. Please, for any of you who have missed any sessions or think it would be useful to have a quick catch up, please do check on our website on the links that you'll have been sent through all of these sessions, where we've saved down fact sheets which range from a couple of pages to a little bit longer than that, where you can look at some of the main points that we talked about, maybe read some of the recommended reading links that we've sent across if you're particularly keen. Next slide, please. So before I start, for those of you who haven't yet signed up for our community of practice, please do scan the code on the screen, which will bring up a link where you can sign up. And on this, you'll be able to access all of the different knowledge materials that we have within the team, not just on disaster risk financing for agriculture, but also for public assets, for for small island states. You can read various papers that we've written or that other partners of ours have written on disaster risk financing. So I think it's very much worthwhile to do that, and you'll then be kept in the loop on anything that happens in our small world of disaster risk financing in future. Next slide, please. So maybe just before I do hand over to the team who will take you through today, I'll just talk about a couple of key takeaways from last session, just to set the scene for today. So next slide again, please. So we mostly talked about why, where, and how you might want to, as a government, support the micro insurance markets, micro agricultural insurance markets. We talked about how the kind of products that have been sold in developing economies such as the USA, for instance, aren't always the most appropriate for smallholder farmers in many of the economies in which we're working, in which you're working. And so one solution to that is to use what's called index insurance. Now, index insurance solves some of these problems around access and around cost effectiveness of insuring farmers. But what they do bring is some risk around basis risk, or the risk that the payout from the insurance isn't the same as the loss that the farmer incurs. And also around kind of farmer understanding, beneficiary understanding of the insurance products that they've been offered. We also touched on the fact that agricultural insurance rarely works optimally when it's just sold on its own. It needs to be part of a broader risk management package, and it's often very effective when bundled with other inputs and services, such as credit, such as drought-resistant seeds, for instance. We see that across low and middle income countries, strong government involvement is absolutely key to the sustainability and quality of agricultural insurance. This may be through premium subsidy support, so that those who can't afford to access insurance can become familiar with insurance, can have access to it so that they can protect themselves and their families. But it's also around investing in data, it's investing in outreach, the enabling environment, in product development. So there's a huge role for the public sector here. But of course, there's also a massive role for the private sector. And where we see the most effective schemes that have been able to scale up, we see these through public-private partnerships. So there's a role for everyone here. Next slide, please. So next slide, I'm going to pass you on to Khalile. But before I do that, maybe as a primer to set the scene for today, could you all get your phones out and scan the QR code on the screen? And give us an answer for which people, organizations, or groups might need to purchase insurance and risk transfer products. I.e., when we're talking about meso and macro insurance, who's buying those products? Who are we marketing them to? Who are we trying to help with them? I'll give you maybe a minute or so just to put in your answers there. Penny, are you able to bring up, or Penny or Sonal, are you able to bring up the results of that Menti poll? Excellent. Okay. So seeing a lot of answers come up here. So of course, farmers are coming up heavily here. So this is predominantly what we were focusing on in the previous session, microinsurance. We're seeing governments. So those are a prime recipient of macro insurance on behalf of their farmers, on behalf of their populations, their pastoralists, etc. I see local governments, excellent. Subnational governments, Ministry of Finance, sorry, everything's moving around on the screen, I'm trying to catch it. Business is excellent. Okay, it sounds like we've got a good idea of what to expect today. So in that case, without further ado, I'll pass you on to Khalile, who will give you a whistle-stop tour around macro and meso insurance. Thank you.
Good afternoon, colleagues. Good morning from wherever you are joining us from. Thank you so much, John, for that overview. So the first section really is a comparative analysis or assessment of the various level of products. Next slide, please. By way of definition, when we are referring to Meso-level risk transfer solutions, we're referring to two different types of financial instruments. The first is parametric or index insurance. This is an index insurance policy that is held by an institution. This could be a financial institution, for example, to transfer default risk. This could be an agro processor or agro dealer, contract farmer to manage production risk. This could also be a farmers association to aggregate the demand of its farmers. So there are interesting cases that we'll look at later on, particularly from DRC by my colleague Christina. Another type of instrument at the Meso level is credit guarantees. So these are an instrument that's usually purchased by a financial institution to mitigate credit risk by transferring part of the losses on their loans in the event of a disaster, of course, in exchange for a fee. In addition to use by institutions, they can also be used by governments and development partners to incentivize lending to underserved segments of the market, for example, agriculture producers or SMEs. So later on, my colleague Fatima will give us an interesting case of Burkina Faso. Next slide, please. Coming to macro level risk transfer solutions. So in this case, we're talking about sovereign risk insurance. This can be on an indemnity basis, but more often we're seeing this on an index-based basis. These are insurance policies that are purchased by a government to provide liquidity or to smooth the budget in times when natural disasters occur. They can be purchased from private insurers in the open market, but commonly what we are seeing is that governments tend to purchase this through regional insurance pools, for example, the African risk capacity. And this is predominantly to improve affordability and for other policy objectives like building regional ownership and technical capacity, etc. So later on, we'll hear a lot more about the African risk capacity. And just to emphasize the difference or to highlight the difference between going with the regional insurance pool and the open market. When a government decides to purchase a sovereign risk insurance through the open market, they of course pay a premium and in exchange receive a payout when a disaster occurs, a disaster that meets the pre-identified trigger levels. However, with the regional insurance approach, in addition to the premium and the payout that they can expect to receive, a government also is liable to pay a contribution for the capital of the risk pool that the risk pool then uses to underwrite risk. And in exchange for that capital, of course, the government is entitled to a share of the profit or the surplus on whatever business that risk pool underwrites. So that's a nuance in the two mechanisms. In addition, or alternatively to sovereign risk insurance, there are other products like catastrophe bonds and weather or price derivatives that can be used for similar objectives to the sovereign risk insurance. However, the mechanism through which they place insurance is slightly different, and they're unfortunately not the focus of this presentation. Next slide, please. So how exactly do these different levels of products differ? So the primary difference really is that micro level products are at a direct relationship between the farmer and the insurer. So the farmer is the policyholder on a micro level product. they pay premiums and in turn receive payouts when a disaster or a shock occurs. Coming to Meso-level projects, the aggregator is the policyholder that pays the premiums and receives the payout. When it comes to the level between the beneficiaries or the farmers that are linked to this aggregator, we see some variation across various programs. In some cases, the aggregator may or may not transfer some of the payouts to the farmers. In some cases, the farmers that are linked to the aggregator may contribute to paying to the premiums that the aggregator pays to the insurance company. When it comes to the macro level case, it's the government that's the policy holder. In most cases, this can be the national government or the state government. They pay the premium, and in some cases, they receive the payout from the insurer. And depending on the objective of the policy, they can then transfer the benefits to the vulnerable farmers that are protected. However, more and more we're seeing programs whereby the insurer directly pays to the farmers or the pastoralists that are covered on that program. Next slide, please. Again, just to highlight or to emphasize that the specific structure of the program determines how the benefits accrue to the various players in the program. And while meso and macro level programs can have significant advantages and benefits, of course, there are trade-offs to be made when we compare to micro level products. So in terms of outreach, meso and macro level projects really do enable programs to reach hundreds or even thousands of farmers at the same time. Affordability tends to be better on meso and macro level projects because of a reduction in operational and administration expenses or costs. When it comes to the supply of insurance, we find that meso and macro level covers tend to be more attractive to both local and international insurers for two reasons. So the first is around scale. So with macro and meso, it's easy to build up sufficient business volume in a short period of time. So the insurers are able to recap some of their development and upfront costs for supplying insurance. On the second aspect, it has to do with the widespread distribution of risk from meso and macro level covers that enable insurers to provide more viable terms than those of micro covers, and those more viable terms in turn enable sustainable supply of insurance. When it comes to the supply of credit, really this is quite mixed. Depending on the nature of the program and the structure, meso risk transfer solutions can enable more lending because it allows financial services providers to increase their willingness and ability to lend because of the protection underlying it. However, to an extent, there's a trade-off because farmers at the individual level are not able to use a meso-level policy as collateral, for example, to gain access to credit. So that's the advantage that a micro-level policy might have over a meso-level policy in terms of access to credit. When it comes to the payouts and to behavioral changes, we see that micro-level products and solutions tend to give farmers more certainty, firstly, over whether a payout will occur, and secondly, over the timing of the payouts. They tend to be more timely, especially compared to meso and micro products that pay to the aggregator or to government for onward payments or transfers to the beneficiaries. And this point around behavioral changes, because of the direct relationship between the farmer and the insurer in micro-level products, policyholders tend to be more confident to invest in their operations and optimize production in a way that that is limited with meso and macro-level products. Next slide, please. And while we see that the rationale for meso and macro level products is strong, the experience on the ground so far is still limited, with micro level products accounting for more than 3/4 of global agriculture insurance premiums. We'll touch on some of the reasons and the trends in the next section. So next slide, please. So taking a deep dive into Meso-level before I hand it over to my colleagues for the case studies. Why, next slide, please. This slide presents a rationale for why an organization would use Meso-level index insurance. We've touched on these in terms of the benefits. Really, generally, we find institutions using Meso index insurance to cover aggregated exposure to systematic risk in a way that is easier and more efficient than micro level insurance for individual farmers. And where the efficiencies come from is around the number and the value of transactions. We also see efficiencies in terms of whether the product meets the needs. Staff of Meso-level institutions typically tend to have higher levels of financial awareness and education to assess or to ensure that the product that they buy meets their needs and offers them value for money in a way that sometimes is not easy to ascertain at micro level. There are benefits also in terms of basis risk. It tends to be lower at the aggregated level that Meso insurance works in. Of course, there are cost savings that we've talked about. And just to highlight this disclaimer, the benefits of Meso-level index insurance to farmers as well as institutions or aggregators really do depend on the structure of the program and the payout roles between the farmers and the institutions that are providing that cover. So careful consideration really is required to define those parameters. Next slide, please. And just to highlight this, there's two cases, give a quick example or quick examples on different use cases. So in this example, this is a regional risk aggregator that's using a Meso-level solution purely for financial protection at the portfolio level, their lending portfolio, for example. They purchase the cover, as you can see from the bottom there in orange. They purchase the cover from the insurer, and the trigger that determines whether a payout is made or not is based on the aggregated loan portfolio. So when a catastrophic climate event occurs, that results in farmers being unable to repay their loan, there's a payout that's triggered to the aggregator. And the aggregator can use the payout to indirectly benefit the farmers. This can be either through rescheduling their loan and interest repayments or through extending new loans that allow the farmers to continue production. In some cases, we see farmers may receive payouts, and in some cases also there's evidence that the aggregator may include a portion on the loan repayment for a contribution into the premium that they pay to the insurance company. But all of this at the portfolio protection level is quite indirect. Next slide, please. Whereas if we look at this example here, this is a risk aggregator that's using a Meso-level product for combined portfolio and farmer level financial protection. And as you can see at the bottom there, the aggregator will purchase the insurance, for example, a rural bank, and they will pay the premium to the insurer. The claim is paid to the risk aggregator, but the risk aggregator may decide to pay, or in this example, they transfer some of the payouts directly to the farmers. So the farmers in this case are direct beneficiaries of the Meso-level index insurance program. Now, there is an additional cost in the structure or in this approach because farmers then are required to understand the product, and so the aggregator bears the cost of educating farmers. Next slide. While the evidence on Meso-level is strong, as we've been detailing in this presentation, the rationale is strong, but on the ground experience is still quite limited. As you'll see in across the world, there is some level of Meso-level index insurance. In blue, those countries are have operational Meso-level products. In red, for example, product the schemes have been discontinued, and there's an interesting pilot case in Mozambique there, shaded in yellow. So part of the reasons behind the limited experience has been that financial service providers, for example, have been slow in realizing and appreciating the value of the solution to reduce their credit exposure. However, the outlook is positive because there's been increasing demand from international development agencies like Vision Fund, as well as emerging technologies that allow, for example, parametric solution providers like Global Parametrics to partner with development financiers. And that's really changing the outlook and expected to increase in the coming years. Next slide, please. With that, I'll hand it over to my colleague, Christina.
Thank you, Kwalile. Good morning, good afternoon, everyone. And thank you again for joining us for this 2-hour session on meso and macro risk transfer products in agriculture. My presentation will cover a case study of a meso insurance product, or it's better said meso risk transfer product in the DRC that we are right now preparing at the World Bank. Next slide, please. This product is actually part of a National Agriculture Development Program, which is a 15-year multi-phase approach, accounting for $1.5 billion investments and aiming at national coverage. This program, implemented by the World Bank with the government of DRC, aims to improve the productivity and resilience of the agriculture sector in the DRC. The phase 1 of this project, which is the one that we are right now implementing, covers 5 regions, as you will see in the right side map, going from the east and to the far west of the country, for an investment of $500 million and for a period of 5 years. The plan for this phase 1 is to cover over 1.7 million farmers by helping them on one side to improve their productivity through the investment in climate smart agriculture packages. This is the core of the National Agriculture Development Program, by improving the infrastructure to facilitate market access for the smallholder farmers. And lastly, which is the reason for our discussion today, is to strengthen farmers' resilience to disasters. The farmers that are going to be the participants in the National Agriculture Development Program in DRC will benefit from an innovation, an improved, enhanced emergency response component that uses instruments existing at the World Bank, but also risk transfer instruments to improve at all levels the access of farmers to support following a disaster, and to protect ultimately their agriculture production. This program is, we call it Meso because we are starting at the subnational level. We have 5 regions, as I mentioned, that will be covered in the phase 1, but ultimately the risk transfer product is going to be implemented and purchased by the government. So it also falls under the macro risk transfer products. Next slide, please. What is the difference that we're bringing in DRC, and why did we need to improve the emergency response component? With the key success factor in mind, that the program needs to secure the income of these smallholder farmers during the transition phase from older agriculture practices to improve climate smart agriculture practices, we needed to improve as well the way we respond to disasters through projects at the World Bank. So the standard way, which is still in force, is that a project will have a contingency emergency response component, what we call a CERC, that is covering both direct beneficiaries of a project in case of a disaster, but also covers the rest of the population in the areas where the project is active. Both responses in the before scenario are done through the same component, and that component is a $0 component that is then restructured when an emergency happens based on a notification from the government. What we have changed here, and you will see in the lower part of the slide, is that we are distinguishing between the response to the direct beneficiaries of the project through an enhanced and improved emergency response mechanism that uses the levers of the contingency emergency response, but also uses pre-allocated emergency response funding and risk transfer. And we keep the functionality, which is very important, of the CERC to cover the rest of the population in the areas where the project is active if there is a disaster. This is critical for the project to reach its intended outcomes. Next slide, please. When we designed the Meso product and the improved emergency response component, we had to have in mind several aspects that are linked to vulnerability assessment and the basis risk. So first of all, we needed to mix the weather shock and yield shock assessments with the balancing effects of the market integration and the price effects, knowing that there is a price correlation with the disasters, but there is also a balancing positive effect of prices and trade patterns that are happening after a disaster. But also we needed, of course, to look at the household structure in terms of production, consumption, and auto consumption of households. Because there can be an effect, a positive effect, of course, of crop diversification. But when we're talking about smallholder farmers that are dependent on the crops they are harvesting, this crop diversification can be significantly lower. So that's on the side of the vulnerability assessment to make sure that we are targeting the right impact for the right population. And on the right side, you see that we also needed to think about basis risk and the data environment in DRC. In DRC, we have noticed there is a lack of historical yield data, first of all, and this clearly impacts the quality of any correlation we would like to do between the moisture soil index, which is the index we're proposing to use for the risk transfer product, and yield levels. So there is a testing component in how well the moisture soil index will correlate with the yield levels, and also a learning curve in developing this risk transfer product in DRC. There's also an uncertainty on price elasticity to harvest. And so what is the impact on the price of the two main crops, maize and cassava, following a shock to the harvest? As I mentioned, the market integration and the price effects can also have a balancing positive impact, and so this elasticity is critical in designing the Meso product. And following that, the last point we needed to look at is the baseline productivity gains from the program. There is an overarching question that comes up: if the program reaches its goals and it improves the farmers' productivity, what is our baseline? What's the right baseline for the insurance payout calculation, and for assessing that there is an economical impact for the farmers, knowing that the effects of the National Agriculture Development Program are intended to be happening over 5 years in phase 1, but over a far longer period, 15 years in total. Next slide, please. So more to the practical part of the project. How did we build it and how it interacted with other risk finance instruments? On the left side, you see the components of the National Program for Agriculture in DRC. So we have three components which are financed with IDA funds. And on the bottom side, you see highlighted the pre-allocated CIRC. So the first innovation is inside the project, there is a subcomponent which we call the pre-allocated CIRC that has 20 million that the government agreed to ring fence to respond to disasters that would impact the beneficiaries of the project. The disasters are broader than weather shocks. They can also be of animal and plant health shocks, but it can also be social disruptions. So this pre-allocated CIRC keeps the flexibility of responding to a larger group, I want to say, of disasters. However, this pre-allocated CIRC is also linked with an insurance policy, with a risk transfer policy that we are currently designing, and that has been made possible with the support of a GRIF grant. The GRIF is the Global Risk Insurance Facility. It's a multi-donor trust fund that we can use to build innovative risk transfer products, but also to build capacity at the government level to sustain over time the uptake of such products in countries. On the right side, you will see how we've layered the instruments we had available to build the final product. And this is, as I mentioned, this work is ongoing as we speak. We have had the help of a lot of technical partners and also colleagues from the bank, and we are actively working with the government to place the risk transfer product on the market for the first time next year. So going from the bottom up, the classical CIRC, as I mentioned, remains a core instrument that will, together with other project mechanisms, will still cover low severity shocks. So this is the classical response that we will rely on in the future as well. And its trigger for funds disbursement is a soft trigger. And by that, I mean the government declares an emergency and costs the response to that emergency. And that's how the funds from the classical CIRC are disbursed. Moving up on the event severity scale, we will use the reserve fund or the pre-allocated CIRC that I had mentioned. And its role is to cover relatively frequent shocks of a higher severity and also more varied shocks. However, it's also very clearly intended to cover weather shocks. And for those weather shocks, we are thinking of a mix between a soft and a hard trigger. For example, the soft trigger could be the alert of a humanitarian association that has that is on the ground and can observe at a very low granularity at territorial level that something is happening. And then we would have a hard trigger, which is really the severity threshold that particular event needs to reach. And finally, for rare but very severe events, we are currently developing a parametric insurance product that will compensate farmers for severe weather shocks that go beyond the ones that can be covered from the reserve fund or the classical CIRC. And in this case, the risk transfer will be triggered by a weather index. We are talking about parametric weather index. And in this very moment, we are focusing on the soil moisture index. Again, everything is still work in progress. And the soil moisture index is the closest to replicate the impacts of previous weather shocks in DRC. Next slide. How to ensure that this product that is still ongoing meets its objectives? Our finding, the most important one, is that an incremental approach is needed to strengthen the capacity of the government, the territorial governments, but also the local private sector. And by local private sector, I mean financial institutions and insurance companies, reinsurance companies, and even the insurance regulator. All this is key. This environment is key to ensure sustainability of the product. An innovation that is happening beyond the financial structure that I have just described is also the fact that we are actively building ex ante contingency plans and identifying disbursement channels and actors that can respond to a disaster, to a weather shock, but also to animal and plant health diseases. So these are documents. This will be annexes to the operational manual, and these documents are living documents that are written with the government and with the stakeholders in the country, and that will be the base for the disbursement of funds from both the pre-allocated CIRC, but also from the risk transfer instrument. As I mentioned, ownership is critical, and by ownership, we clearly mean the agricultural ministry, the public institutions, but also the private sector. The private sector needs to be involved and its capacity strengthened incrementally to take on in the future this solution and incorporate it in the offering for smallholder farmers, but also for aggregators in the country. I also mentioned that we had to look at data collection because DRC is a very data poor environment, and that can pose a risk, an increased basis risk. So we are working actively with the support of the Grief Trust Fund to create capacity through technical partners and also to train stakeholders in DRC for data collection and data storage. And the sustainability aspect is an overarching aspect, as I mentioned, that involves the local players and public institutions. Thank you very much. I think with this, I have finished my slides and I am happy to take questions later on.
Thank you, Christina. So following DRC, I will take you now to West Africa in Burkina Faso particularly, where the World Bank is supporting a 6-year lending operation aiming to increase access to financial services and access to credit for farmers and SMEs. Next slide. So the PCG, first of all, let's have an overview of what is a credit guarantee scheme. This is a risk mitigation instrument, particularly credit risk, which the aim to encourage financial institutions to provide financing to underserved segments such as SMEs, agri-producer, by absorbing part of their losses on the loan in case of default. For a fee. So this is, it's not free, it's a protection offered to financial institutions, and they are contributing, paying a commission to the guarantee management company for the government. This is a common instrument used in the financial sector to unlock access to credit. And I would like to highlight 3 main design parameters which make CG's credit guarantee scheme a more and more demand for credit guarantee scheme in developing countries and overall worldwide. The first one is the coverage ratio. This is the share of losses underwritten by the PCG. If this coverage is low, financial institutions will not be interested to participate or might not lend to high need borrowers, so will miss the objective of encouraging lending to underserved segment. And then if this coverage is set at 100%, which is providing a full protections against default to the financial institution, then they might lower their credit appraisal and monitoring standards, which we don't want as well. We want this, we don't want to disturb the financial sector. So it's important that the coverage ratio is high enough to attract financial institutions, but it should not eliminate the risk entirely from them. So in the case, and in most cases, credit guarantee scheme are partial credit guarantee scheme where the coverage ratio vary from 50 to 75. In other cases, in particular in the context of COVID, we saw that some of credit guarantee scheme, government scheme particularly, offer almost 90% coverage ratio to financial institutions. The second parameter I would like to highlight, and I think this is also one of the key parameters which contribute to make the PCG a key policy response to support underserved segment, is the leverage, which is a multiplier effect allowing to guarantee loans higher than the size of the credit guarantee endowment. This is a way for the government to crowd in private finance to support the segment that they think is underserved by the financial sector. The third parameter that I would like also to highlight is the distribution model. Credit guarantee scheme can be applied to loan by loan approach, which we call individual guarantee, or a portfolio approach using a set of pre-agreed criteria to define this portfolio. In the case of Burkina, we decide for a portfolio level credit guarantee scheme. The scheme has the project with the support of the World Bank set up this partial portfolio credit guarantee scheme with an endowment of 55 million US dollar. And this credit guarantee scheme has several windows, and one of them is dedicated to the agriculture sector with an endowment of 15 million. Next slide, please. As I mentioned in the introductions, PCG is really an important, is more and more used by policymakers to support firms, underserved segments such as agri-producers. And it offers several benefits, including, as I mentioned, crowding private financial resources, but also the possibility of revision of lending terms, such as reducing the amount of collateral that is required, extend the terms, extend list of lenders to a specific sector or group. And the most important one is also what we call the additionality part, is the introduction of new borrower that will not otherwise qualify for loan from financial institutions. So this is a key element, a key benefit of the PCGs. And in the case of Burkina, with the credit guarantee scheme, we realize that 70% of the borrowers that we have that are benefiting from the scheme are new borrowers that will not qualify otherwise before the scheme was in place. So why we decide to establish such solutions in Burkina, next slide, is the challenge that we see when we conduct the analysis. Agriculture sector contributes to about 30% of the country GDP. And in terms of employment, is more than 65% of the population working in this sector. But access to credit is really low. And from the banking sector, is less than 4% of their lending portfolio goes to agri, and 15% on the microfinance sector side. Several factors contribute to this, and one of them is really the lack of appropriate collateral. In Burkina, collateral requirement for loan can reach up to 120% of the value of loan, and it's mainly fixed collateral, while most individuals, particularly farmers, have movable collateral. In Burkina, only 8% of farmers have a title on their land. The second reason as well, contributing to limit the appetite from financial institutions to lend to agri sector, is the perceived risk. This sector is exposed to production risk, market risk with price and also in the context of Burkina, the insecurity situations. And when we speak about production risk, climate vulnerability to climate risk is the major concern. As a survey we conduct demonstrate that 2/3 of households report having suffered from a shock every year. And production in Burkina is mainly rain-fed, with only 1% of the land are irrigated. So climatic hazard like drought and flood represent the most severe peril for farmers. And this is also challenging for financial institutions given the lack of risk mitigation solutions in place in Burkina. So we decide to establish the credit guarantee scheme to unlock access credit for farmers with a dedicated agricultural window. This window has a coverage ratio of 70%, which in case of default, the financial institution will receive, the credit guarantee fund will reimburse 70% of the value of the loan. And it has, the endowment is 15 million, but with a multiplier effect of 2, then financial institution can lend up to $22 million of loans to farmers. The credit guarantee scheme in Burkina is operational for more than 18 months. We currently have 4 participating financial institutions, 3 banks and 1 MFI, and we just signed agreement with another 4 institutions, including the largest MFI in Burkina. So as of now, we have the PCG in Burkina is providing protections to more than 100,000 loans extended by financial institutions. This is what the challenge we had and the solution we bring to resolve the issue of access to finance in Burkina for agri sector. As I mentioned, so in normal situations, this is access to credit is constrained for agri stakeholders. When there is a shock like flood or drought, these constraints are exacerbated. So there is a need to find solutions to ensure that when the shock happens, then financial institutions can continue to extend loan to farmers for them to recover rapidly. So it's important to make sure that the credit guarantee scheme has the funding available in the aftermath of shock to incentivize financial institutions to lend to targeted segment. But in the aftermath of shock, then we might probably have significant default and therefore significant claim from the credit guarantee from financial institutions. In the aftermath of shock as well, on the government side, it can be challenging to add additional resources to the credit guarantee fund, given the limited fiscal space available in the case of Burkina. So we are looking at, and this is really an innovation, the activity we start this particularly following this year, and exploring an insurance arrangement to backstop the agriculture window of the credit guarantee schemes. Next slide, please. So we decide to announce the credit guarantee scheme that we have and the key design consideration that we, as in this process, first of all, was to make sure that this might seem very basic, but it's important to have the credit guarantee scheme well established, working, having the governance and the risk management framework in place before considering adding a complex insurance arrangement like we are envisioning. And as I mentioned, it took us like almost 1.5 years of running, and the credit guarantee fund manager, Sofigib, is a well-established institution with long experience in managing guarantee fund. The second design consideration was the scope. credit guarantee scheme offer all credit is a risk mitigation for default. So it's for all type of cause, of all type of reason where a farmer or a firm default. So we were considering initially to transfer the entire credit risk to the reinsurance market via credit risk transfer options, but to protect against all credit risk. However, given the level of development of the credit infrastructure and the fact that credit risk transfer for all credit risk require a significant year of information and data on underlying loan, especially loan performance, which we don't have in Burkina. So this all credit risk transfer solution is more a medium and long-term solution. So we end up revising the scope of what we are doing and decide to focus the credit guarantee scheme to ensure it against climatic hazard, particularly drought, likely to create large-scale credit losses rather than directly ensuring the credit risk. The third design consideration that we had was the data. As I mentioned already, data is challenging. The available data required for designing solutions in Burkina was challenging to get. And we are, as part of the project, we are supporting financial institutions to refine and strengthen the data collection system. And the last core design consideration is, again, the regulatory the framework for insurance and also the involvement of national insurance stakeholders from the beginning of the process, engaging the discussion and see what role they can play. Next slide. Is how this project is interacting with the other risk financing solutions in Burkina. As I mentioned, this is new. We are just starting exploring the feasibility analysis. We are currently working on the feasibility analysis. But as of now, in terms of risk finance instrument in Burkina, the Ministry of Solidarity has adaptive safety net. On the Ministry of Agriculture and Animal Resources, they have the grain reserve, which has a physical and cash component, and they are running a national agriculture insurance pilot program. On the Ministry of Finance, there is budgetary reserve and now the credit guarantee scheme for agri-window. So this is common in many developing countries where there is different instrument, but the country lack of a risk finance strategy. So we are currently working with the DRF diagnostic also to inform us on how the different instrument will work, what can be the complementarity between them or not. And this work is jointly with our social protection colleagues, as the poor and particularly in Burkina are the most affected by disasters. Next slide. In terms of how we ensure that the project meets its objective, the first one is really the quality design of the instrument, the design of the PCG itself, ensuring that it minimizes moral hazard and adverse selection. That's the reason why we decide to go for a portfolio level guarantee scheme. Also, we embedded in the design risk management framework of the PCG, such as stop losses, and also, and finally, we include the insurance arrangement now, which requires strong analytical work. The second key element to ensure that the project meets its objective is also capacity strengthening. This is essential to ensure the ownership of the stakeholders, and this happened from all stages, from the beginning of the process when we start thinking of what can be solutions to feasibility analysis and throughout the entire process. And it includes residential TA for all participating financial institutions, from the guarantee management company to banks, MFIs, and later on, if we are working with national insurance company, this will be also part of the process. And by this, we will ensure, it's a way for us to ensure that the capacity is available within the country when the project will close, so they can continue to run the credit guarantee scheme as well as the insurance arrangement as a backstop. Thank you for listening, and happy to take questions later on this innovative scheme that we are setting up in Burkina. Over to Malvern.
Thanks so much, Fatima and Christina, for those very illustrative and interesting presentations, practical use cases, applying Meso-level risk transfer solutions in agriculture. Just before Malvin comes in on a specific case from ARC Limited, I'll just quickly provide an overview of macro-level risk transfer for agriculture. And before I dive in, I'd really like to invite the audience to please keep the questions coming in the chat. Just type your questions. Someone from the team will pick up and respond as we go or at the end of the section. So coming to macro-level index insurance to finance disasters, this slide presents a rationale for why macro-level index insurance is useful and critical to finance disasters. As you'll see here, there are four sets of reasons or benefits from macro-level index insurance. The first in the blue box there is about direct welfare benefits that macro-level solutions can provide. Studies have shown that late response when a shock occurs can be more costly for households. And this is in terms of nutrition and consumption, firstly, but secondly, in terms of their capacity to earn. So the earning capacity or potential of households can be severely affected by disasters, but the use of macro-level solutions can help limit those that impact. The second set of benefits from using macro-level insurance is around coping strategies. So again, countless studies have pointed to the fact that vulnerable households tend to cope with disasters, sometimes by selling productive assets, including livestock. In some cases, households reduce consumption for everyone in the family, and in cases, households resort to pulling their children out of school for a limited period. However, these coping strategies can have long-term, irreversible, and sometimes intergenerational effects. So by providing finance to respond proactively or in a short space of time, macro-level solutions help to preempt and prevent such negative coping strategies. Moving on to the bottom right-hand corner, the box there talks about macroeconomic benefits that accrue to government at national level. What macro-level index insurance enables governments to do is to reduce their need to divert resources away from basic public and social services, and therefore this helps to protect any development gains that have already been realized in that country. And because of the insurance mechanism of transparency, pre-arranging finance, and pre-identifying beneficiaries, insurance really does help to reduce leakages in the financial system. It helps to improve financial discipline at the state level, and also it helps to limit budget volatility, which overall combined contributes to fostering national stability. Lastly, in the bottom left-hand corner, there are benefits that accrue to the humanitarian sector. So studies again have demonstrated that acting early, which macro level index insurance enables governments and other actors to do by providing funds very early, enables or reduces the cost of humanitarian aid funding. Some studies cite that costs can increase up to 7 times compared to early response. Other studies cite cost savings of about 30% if funding is provided in a more timely and predictable way, as is the case for macro level index insurance. Next slide, please. We have touched on this briefly in the overview section, looking at how macro level insurance can be used. And there are 2 distinct cases. So one is really at the sovereign level, where government is both the policyholder and the beneficiary, such that when a payment occurs, a lump sum or the lump sum is paid to government, and government can use that at their discretion. This type of approach is really aimed at stabilizing the budget and accessing liquidity when shocks occur. The second case is a variation whereby government is the policyholder, but it purchases the policy and holds it on behalf of beneficiaries, for example, households, farmers, pastoralists, etc., such that when a payment is triggered on the policy, payouts are made to the beneficiaries, the pastoralists, the farmers, etc. In some cases, we do see programs where the insurers pay to government and then government transfers funds to the ultimate beneficiaries. However, more and more we are seeing programs whereby insurers pay directly to the beneficiaries, the farmers, etc. This has the additional advantage of increasing financial inclusion because it requires farmers and beneficiaries to already have either bank accounts or mobile money accounts through which they can receive their payments. So there are other policy objectives that an approach that allows insurers to pay directly to farmers can help achieve beyond direct protection. Next slide, please. And so quickly, before Marvin comes in, I'll give 2 examples. The first is a case in Mexico. So Mexico was one of the first countries globally to introduce a macro level index insurance scheme. This targets both crop and livestock cover. The objective really was to stabilize farmers' consumption and income until the next season. One of the most notable impacts or achievements of the scheme is that it has enabled beneficiaries to increase their expenditure, on-farm expenditure, by about 27%. And it has enabled beneficiaries, farmers, etc., to increase their incomes by 38%. So we are seeing both ex-ante and ex-post benefits from the program. In terms of the risks that are covered, it's really climatic perils, drought, excessive rainfall and flood, frost and windstorm. It covers crops, livestock, and fisheries. The beneficiaries that the government of Mexico targeted are subsistence, small-scale farmers that did not have access to formal bank credit. So it had the additional objective of enabling farmers, underserved farmers, access to financial services. As of 2011, the scheme had reached about 2.5 million farmers, or equivalent to about 56% of the total number of farmers across 31 states in Mexico. Coming to the modalities of the operation of Cadena, we see that it is the state government that purchases the policy. And in order for farmers to be eligible for cover, they need to be registered with the local municipality in their area. Premiums are 100% covered by government, However, this is shared between the state and federal government in the ratio of 20 to 80. In terms of supply of insurance or coverage, this is carried by the insurance market. Both the private commercial insurers as well as the state reinsurer are involved in provision of cover, and it's based on a tender basis annually. So the key takeaway from the Cadena program really is that there's a strong public-private partnership in place that enables sustainability of the scheme, but also there is strong coordination between state and regional governments that enables the program to target and fund the beneficiaries in question in a sustainable way at scale. Moving on to the next slide, please. Now we give an example of Kenya, where there is a livestock insurance program. This is a macro level pasture drought index insurance cover. It provides payouts when a drought occurs, and the objective really is to provide asset protection. It's to enable farmers to be able to keep their core breeding livestock alive when a disaster occurs. Asset protection is the objective rather than livestock, to prevent against livestock mortality. In terms of the risks that are covered, predominantly it is drought. That's the major peril facing pastoralists in the arid and semi-arid lands of Kenya in the northern areas. As of last year or currently, the program had reached 20,000 vulnerable pastoralists with cover. And in terms of the modalities or the implementation of the program, the policy is purchased by the State Department of Livestock. So this is a department within the Ministry of Agriculture, Livestock and Fisheries. And the department pays, or government pays 100% of the premium for the cover on behalf of pastoralists. In terms of the pastoralists that are covered, these are identified by the State Department of Livestock with help from the county administrators as well as the local community leaders. Local insurers provide cover, but then they bid for this on an annual basis to ensure that the program continues to be priced and delivered on a competitive basis. And finally, the payouts, when a drought occurs and the insurance is triggered, payouts are made directly to beneficiaries' registered bank or mobile money accounts. So key takeaway here is, I suppose, on the financial inclusion aspect, the digitization of the payment system that has enabled the program to reach, even remotely located pastoralists through the program. And of course, the strong public-private partnership between government and the private insurance sector, we're seeing that very critical to ensuring sustainability of the program. With that, I'll hand it over to Marvin to take us through the ARC example.
Thank you very much. Good day, everyone. Welcome to this, this presentation. Glad to see that there are a lot of ARC friends, partners, also, in the participants list. So maybe before I start, I'll just maybe try and kind of piece together some of the information that's already been shared regarding sovereign risk pools. So just also to state that ARC is Africa's first sovereign pool, and since inception in 2014, we've actually assumed nearly 1 billion worth of risk, in main agriculture. We now have a tropical cyclone. So even though we are classed as a sovereign risk pool, we also have a structure where we allow humanitarian actors to take out policies. We call that replica, and to date we've had reasonable success with the World Food Programme and START Network. And I suppose in terms of the presentation, you'll also see that the main issues that affect both micro and meso level insurance are also experienced within the sovereign context. So why was ARC actually formed? Essentially, ARC was formed, at the instigation of the heads of state, who, essentially realized that there was a lack of disaster preparedness, and that essentially led to very ad hoc post-disaster response, in the absence of pre-arranged financing tools. So with ARC, the value proposition is to really improve disaster preparedness and response by assisting countries to prepare, plan, and respond to disasters, and more importantly, just to shift really from the post-disaster response to pre-arranged financing. You heard earlier on about the benefits of moving from the benefit of actually responding early. I think up to 7 times, which is really the highest that I've heard in terms of those studies. But that basically shows the value of pre-arranged financing. Next slide, please. So, what do we consider when we're designing a sovereign macro product? So, as the first risk pool, the key issue we wanted to address was to come up with the standard customizable products for each country context. So that essentially meant deploying our platform, our drought monitoring platform, which is called Africa Risk View. And the main product that we offer to date is based on the water requirements satisfaction index, which basically means that every crop, has a water signature requirement. So maize will have different water requirements compared to millets, compared to groundnuts. So essentially, countries can actually choose which crops they want to model in terms of food security. We use satellite rainfall data to update the model on a decadal basis, so every 10 days. And through the water signature requirement, we are able to essentially calculate the extent of the droughts in the various regions, and also through using vulnerability profiling and various income reliance on agriculture, we're able to also estimate the number of people who are affected, which essentially leads to us being able to calculate sort of what we call the model drought response cost, which is essentially the amount that the government has to set aside, for drought response. The key sort of part of ARC's product is really the pre-approved contingency planning, which is essentially part of the money out systems. So essentially, before a country can actually take out, a country or a replica partner can take out insurance with ARC, there needs to be a pre-approved contingency planning. So a pre-approved contingency plan, which essentially details how the response will be, how the funds, from any payouts will be distributed. Will this be distributed to individual households, or will there be food distribution, and who would the distribution? Most of the studies actually show that if you don't have this pre-approved contingency plan, then the benefit ratio decreases substantially. So this is a really a key aspect of the ARC product. And in terms of the design, in terms of risk transfer parameters, I'll cover that in a separate slide. But essentially, we are able to offer different parameters for each country in terms of how much money they want to, how much coverage they want to purchase from us. And we use the attachment and exhaustion point, and we also use what we call the ceiling percentage to really kind of scale the amount of coverage that the country buys from us. And usually the key thing there is just essentially budgetary restrictions. So countries will tell us we've got X amount of millions that we want to spend for this product, and essentially we've been able to come up with a solution that can work for for each country. So just to say that, as you can see, this model is quite sophisticated in a sense. So we are also now moving to other types of models. So last year we launched the rangeland model, which is basically a model that countries can also use if parts of the country are actually used for by pastoralists in terms of reliance on agriculture. So we're actually able to combine the water requirement satisfaction index with the rangeland model, which essentially looks at at the levels of pastoralists. Next slide, please. So in terms of how our product interacts with other risk finance instruments, you'll see that we've got the attachment point, which is essentially what some people call the entry, and then the exhaustion point, which is essentially the exit. So the key issue that we have, or that we've actually seen at ARC when we deal with the countries, that very few countries actually have a basket of tools that they can use. So as detailed in a previous presentation, the insurance is only really supposed to start attaching at sort of medium to high impact events, and there's supposed to be other instruments that really sit beneath that. What we've found is that there are no, there are very few instruments, if any, and then also you will see that the box that's shaded with ARC is quite, is still, it doesn't cover, that layer between the attachment point and the exhaustion point, which basically means that there's still a gap in terms of the coverage. So this gap, cannot, in terms of the insurable layer, can be addressed, by the replica, because essentially what the replica partners do is they'll come in and purchase, a like-for-like insurance policy based on what the government has in terms of the attachment point and the exhaustion point, so which basically reduces this gap. But so far, it's not been possible to really, cover out and sort of to really address that gap. But that's part of the work that we're doing with our partners to essentially get countries to use PIMA financing first, as a means to sort of testing out the products, and then hopefully getting payouts, and then being able to sustainably participate in the risk pool, but also with through the ARC replica program, we're also using humanitarian actors who can also, we're based in those countries, who then complement the response plan. As you can see, there's a number of sort of instruments that could be used. So from CAD bonds, which I also mentioned before, CAD DDO, so there's quite a multitude of instruments, and essentially these are required because it's not possible for ARC or for any one particular player, to actually come up with a tool or a sort of tool. So a more sort of cohesive approach to sort of risk layering is actually required. So this is the theoretical approach, but I'll just sort of really mention again that for most of the countries, quite a few, there's very few countries that actually end up, or that can show you a disaster risk financing plan. And for those that can show you, most of the time it's not fully funded. So by that I mean, if there's a box for a contingency funds or reserve fund, it's very rare to actually find that amount actually being available to fund any sort of drought event. So it's there in terms of the strategy, but it's not fully funded, which essentially means that in most cases those countries are only relying on on the ARC insurance or some other mechanism, but it's very rare to see a sort of a concoction of tools, which is really important in terms of risk layering, because the value will be the value of insurance is actually is highest when it's used in combination with other tools. Next slide, please. So on this, I'm just really going to focus on the water requirements satisfaction index, and this is really so essentially, there are a few things that we use. So the first one is really the benchmark in terms of drought detection. So we've had to impose minimum standards in terms of data. So essentially, what we're saying is that if we're saying a benchmark of 5 years, we're essentially going back the last 5 years to say, at a minimum, a country cannot select less than 5 years, in terms of the benchmark, because then it becomes less credible and then more volatile, which could lead to basis risk, which is a key problem that we have with parametric insurance. The second issue, the second sort of design feature that we've actually had to also implement is essentially just starting to use rainfall data sets, and therefore all the sort of droughts from 2001, because we found the data quality of pre-2001 droughts to be quite low and very difficult to actually validate. And also there's been significant changes in terms of the agricultural practices over time. So we found that that also works. And then the third one is really around the risk layering approach. For the reasons that I just mentioned in the previous slide, we've actually found that a lot of countries were buying insurance, to attach at very low levels, essentially below 1 in 4. And as most of you will appreciate, the benefit from insurance is not really obtained when you use insurance as a tool to protect from high frequency events. So we've had to essentially dictate that insurance has to attach from a minimum of 1 in 4 going up. Also as a catalyst to get countries to actually look at bringing in other tools to complement insurance. Basis risk is a key feature, and if you have any discussion on parametric insurance and you don't hear basis risk, you must always be concerned. And so from our perspective, we given that we've now got 8 drought risk pools under our belt, we've essentially we had a process where we had to improve the model customization process and validation process. So essentially what we do is we've got what we call customization review committees that are regional specific. So if you are in West Africa, they will look at Senegal's customization, they'll look at the Gambia's customization, compare the two to understand any significant differences, because in general there should be some similarities between neighboring countries in terms of the parameters that are used within the model. So that group of experts essentially looks at those customization and those parameters, and essentially posts or questions to the technical working group who are responsible for coming up with those parameters to justify any significant differences. And we also have we're trying to use the most recent data sets to reduce basis risk. In terms of the model itself, we also use what we call independent loss calculation, just to make sure that our platform, Africa Risk View, which I mentioned earlier, is accurate. So, we always sort of do that in terms of just to make sure that we are not, we're not making any sort of errors. And then the final point that we really make is that the countries are responsible for the choice of crops, in terms of the parameters that they choose, obviously subject to the quality control process. So, because at the end of the day, you want the countries to take real ownership, because it's their risk pool, but it's also their product, so that there is no, or ARC said this is the correct thing. At the end of the day, we rely on on experts that are in country to parameterize the model. We also help them, but essentially, it is really country owned, and and also we have flexibility in terms of the selection of of risk transfer options, subject to the minimum attachment level, which I sort of highlighted earlier on. So these are the the key issues that we had to address. The other thing that I'll just say is that also in terms of the risk pool, I think there's a comment earlier about the capitalization. So we are actually, the company, the insurance company is actually structured as a mutual, so that which basically incentivizes countries to to participate, because as you know, a mutual insurance company is basically the members are the policyholders, so the members also participate in the various governance that you would expect members to participate in. Next slide, please. So what are the challenges in terms of risk reduction and product design? So there are no explicit risk reduction incentives that are part of the product design. It's very difficult to incorporate an explicit incentive, but essentially what we do realize is that if there's risk reduction that's done by the governments, whether in terms of improving or reducing the vulnerability of the population to agriculture, or by increasing or diversifying the income streams indirectly, that will result in lower premiums, because the less number of people that are liable or that are vulnerable to drought, the less the potential cost in terms of response to droughts. But it's clearly not embedded, and we have to look at how we can embed or essentially come up with direct incentives to essentially drive investment in risk reduction, because insurance and risk reduction are not mutually exclusive. We would really like to see risk profiles of countries reducing, because then that essentially means that they're investing in risk reduction programs that benefit their populations. In terms of the challenges, I think you will probably guess from an earlier slide that the lack of holistic risk layering approach is clearly a very big issue. There are very little, or there's little to none in terms of tools to complement insurance. Also mentioned in another presentation earlier was around data. Data is a key issue, and there's significant investment that also need to be made at national and regional level to actually improve the quality of data. And lastly, since we are formed as part of the African Union, we actually do require a political environment that can essentially incentivize countries to adopt the various risk management activities to be more proactive, and we also require institutional support as well as regulatory frameworks that enable us to participate in the various countries. We've made progress, but in some countries, a question or an issue or a request for clarification regarding how our ARC could participate, within the, as a sovereign insurer, could actually take a year to resolve. And given the video that predated our this presentation, a year is clearly too much, given the various disasters that can actually occur, and the number of people who can resort to negative coping mechanisms. In terms of how they how they sort of respond to the various unfortunate events that unfortunate but predictable events that actually afflict them. And then maybe just before I end, I would just like to address a few other points that are related to the kind of coverage and how we see the sovereign market. So although we are kind of listed as a sovereign insurance company, that's our bread and butter, but we've also realized that we do need to move our focus, in a sense, from the typical disaster to sort of asset protection, because there are various schemes within the countries on the continent that actually speak to that. So in terms of highlights, you'd find that a lot of countries have what we call national agricultural insurance schemes. So CLIP is a version of a national agricultural insurance scheme, but essentially, we can also provide cover for that, and we've also realized that not all regions of a country are actually afflicted by drought. So the Meso approach actually helps us to be able to target specific regions, which are sometimes difficult to do under the existing sovereign approach. I think that's it really in terms of what I have to say today.
Thanks, Marvin. I think the presentations today have been absolutely excellent. So thanks to you, and thanks to Fatima, Christina, and Khalile. I think we're going to open up for questions in a couple of minutes. Maybe I could just first take 60 seconds or so just to talk about some kind of take-home messages and conclusions from today's session to wrap things up. Next slide, please, Penny. So yeah, if you're going to take away 4 points from today, what would they be? Well, firstly, this meso macro insurance, like micro insurance, like any other disaster risk financing instrument, these should be specific to the challenges faced in a specific country by farmers, by financial sector companies, by government. So, for instance, you might want to protect the production of individual farmers and have like direct incentives for them to reduce their risk through mitigation, or to access credit, in which case, okay, maybe the solution is microinsurance. But if your sole objective is to increase their access to credit, increase their potential investment in productive technologies, productive practices, then maybe a partial credit guarantee makes more sense. Maybe meso insurance makes sense. And further, like, none of these instruments are mutually exclusive. They can go hand in hand. They can be designed to complement each other, to cover different risks, different sectors of the population, different perils. The structure of the micro and meso level programs can be made different to achieve different objectives. So I suppose this is similar to the point I've just made, but even within a meso insurance, as you saw from Khalile's presentation, we could have one setup where this is really to protect the aggregator, whether it's the financial service provider or whether it's a seed producer or something, so that they're more incentivized to engage with the farmer, to provide them with the finance that they need, to provide them with the inputs that they need. In other cases, you might set it up so that the farmer has a specific, sorry, my phone's going off, to have a specific guarantee, a specific protection for those farmers. But instead of operating at a micro level, you operate at meso level to reduce the costs and to increase your outreach. One reason that we might use meso and macro insurance is to help reduce basis risk by compared to micro insurance. So micro insurance, if the insurance company is making payouts to an individual household that has a small plot of land, for instance, their experience is going to vary massively from household to household. It's what we call heterogeneous experience. When this is done at a meso level, when this is done at a macro level, it's much easier to get your modeling right, so that you know, okay, well, if we've had these conditions that we can observe through an index insurance product, we think we can more accurately represent the aggregate experience rather than the individual experience. And now, of course, this doesn't get rid of basis risk. We still have basis risk on the part of the government, on the part of the organization, when transferring the payouts to individual households, if they're going to do that. So the point is, whilst it might manage basis risk, this doesn't get us off the hook in terms of making sure we have really good data, making sure we have really good modeling. So yeah, maybe I can stop talking now, and we can focus on some of the questions that were received from the audience. Please do keep them coming. We do have plenty of time to answer some of the questions. I think I'll probably start with a really great question we had sent across before the session. So the question reads: what does it take for disaster risk financing flows to trickle down to smallholder farmers? What incentives and capacity do financial service providers need? So I think this is an absolutely huge question. So I'll try to break it down into a few different parts. I think our panel, which include all of the speakers today, plus also our resident expert Charles Stutley, can take different parts of this. So I think there's part of this question which focuses on meso insurance. So how can we make sure that payments are made to individual households if that's the objective of meso insurance? And if it's not the objective of meso insurance, what are the benefits for individual households, individual farmers in this? For macro, I think it's a lot more of a question around planning and around payment systems. So perhaps Malvern and perhaps Charles could take a stab at that question. And then also it'd be good to hear from Fatima on how partial credit guarantees have an impact on individual borrowers. Is this through increased access to finance? Do they get some explicit benefit when the partial credit guarantee kind of kicks in following a default or following a disaster? So I'm not sure who wants to go first. Maybe Charles, you could take us through a little bit of your understanding and your experience in this area. If not, anyone else, do feel free to jump in.
Hi, John. I'm not sure which international organization asked the first question about DRF flows and trickle down. How long does it take to get smallholder farmers? You know, we recognize that there is this huge international humanitarian disaster relief programs which have operated for many, many years, and some of the sort of criticisms levied against them are that it takes a great deal of time to mobilize funding to then either purchase food aid or if it's going to be cash transfers. And often there are difficulties about who does the benefits actually flow down to. Is it the intended beneficiary? Do you have issues of rent seeking, etc.? I can only really sort of address this from my experience in the insurance sector, where you've got an insurance, either a meso or a macro level program in place. It's an ex-ante instrument. You usually have identified who your target audience will be. The advantage of an insurance payout, and we can hear from ARC, is that usually once you've triggered a payout, it may take 10 days to 2 weeks to actually affect that payout, either to government or to your aggregator to then distribute to farmers. It was interesting, we were looking earlier at the Cadena, which I think was a highly innovative program in Mexico. Unfortunately, one of the biggest problems of that program was that although insurers and their reinsurers triggered very rapid payouts to the individual state governments, we then found there was a big block, major delays in the benefits being distributed to the municipality level and individual farmers. And I think some of the work the World Bank has been doing has tried to overcome that. I'd be very interested to hear from Malvern about, his experience of making payouts directly to governments and the time taken to distribute to the beneficiaries. But we tried what we would call in the World Bank the modified macro level approach, whereby in Kenya, for example, the Kenya Livestock Insurance Program, all of the beneficiaries are pre-identified, pre-registered. They have to have either a mobile phone with a money payment system or a bank account, so that when a payout is triggered on that macro level policy, the payouts made directly to individual beneficiary accounts. And that's an agreement with the government of Kenya. If we've got anybody here today from World Food Programme, Ethiopia, they're doing a very similar thing there. It's called a Meso-level program, but a prerequisite is that the beneficiaries are pre-identified and payouts are made directly to them. I'll leave it at that for the moment. Thanks, John.
Thanks. So maybe let me just fresh off the heels of Charles there, I'll just maybe give a bit of perspective in terms of our experience. So I think the key issue here is around the pre-arranged contingency plan, which is essentially a money out system, and the greatest benefit is is derived by having pre-identified beneficiaries. So most of the literature will actually tell you that the most effective way of transferring payouts to the individuals by the government is through mobile money cash transfers, which are which are essentially based on scalable safety nets. But it really depends, because the other angle, when you then overlay the issue of gender bias in terms of the access to to financial services. So essentially, in some of the countries, the bank account is actually mainly held by by the male figurehead of the family. So there's also other issues that then come into play in terms of access to that money and ability of those funds to be used for food. So it's not a straightforward issue, but essentially, we then also place a lot of emphasis on the post implementation sort of reviews. So we have mandatory monitoring and evaluation that takes place during and also after. We also require, we need to have a look at how quickly those funds were deployed and whether they were actually deployed to the people that the funds were meant to the people we're meant to benefit. And if it's the case that we find that there was that wasn't the case, then a country is essentially barred from from participating in the risk pool. But it's not a one size fits all. It really depends on the targeting mechanism, and essentially the targeting mechanism can make or break the effective flows of the funds to the ultimate beneficiary. Thank you.
John, can I come?
Please do, Fatima. Absolutely.
Yes, on the credit guarantee scheme, in terms of additionality, what we've seen since, as I mentioned, this is a scheme that is running for almost more than 18 months and based also on experience in other countries. Currently, in the loans, out of the 1,000 loan for the agri window, the credit guarantee scheme in Burkina has more than 3,000 loans, 3,500 loans, and the agri window is 4,000 loans. As I mentioned, in terms of additionality, 70% of those loans are new loans that financial institution will not lend if there were not guarantee behind it. That's a key element for us, and particularly for the project, which is a financial inclusion project. The second element we've seen in from our analysis of the agri window, we were able to see only 2 main production season for the agri. And I mentioned it generally for the agri sector, lending can be, for overall lending in Burkina, collateral requirement can be high as 120% of the value of the loan. But with the credit guarantee scheme, we are seeing lower requirement from financial institution in terms of bringing collateral, for borrowers to bring collateral. This is, we did not quantify exactly the percentage of what they are requesting, but this is reported in terms of reductions. We did not see yet an impact on interest rates. The rates are still the same apply by the financial institutions, but we are seeing new borrowers coming in, lower collateral requirement, but not yet an impact on interest rate. I would like to mention that we are also doing an impact study of the credit guarantee scheme, and the midline is planned for next year. So we'll probably have more to share by then when we'll have the midline finding. Over.
Maybe to add from the experience in DRC, from an operational standpoint regarding disbursements to farmers, inside the National Agriculture Program, we are also building an agricultural registry. And in that registry, we are identifying all the farmers that will be part of the program, and IDing them, and also providing them with either cards or vouchers. The information they are giving relates to the exact geolocation of their parcel, the size of their parcel, the crops, and so on. And this allows to track these farmers, also to be able to pay when disaster strikes to the right people in the right areas that are impacted. And so this is one approach we took to improve disbursement and to ensure that beneficiary farmers are the ones getting the payouts. And secondly, as I mentioned, more of an overarching document is the contingency response plan that identifies the rules of disbursement and the actors that will be involved in the disbursement. And we are in discussions with WFP, for example, given their experience in DRC, to make sure that these actors are ready to go and ready to help us when disaster strikes. Over.
Thanks everyone for the comprehensive answers. There's also a question in the chat box from Laura Evans, which I know that Malvern has already started to, well, provided a good answer for. This is a question, in DRC, is there a possibility to purchase insurance from ARC? And I'd like to maybe pass that question on to Christina in the first instance, as well as the rest of the team, but maybe make it a little bit broader than that. So acknowledging that there are a lot of organizations, including those represented on this call, the World Bank, ARC, universities, other technical organizations, governments, individual consultants around the world, insurance companies, etc. How can we work together? What are the different kind of skills and comparative advantages that these different organizations bring? How can we go from at the moment where meso and macro insurance are still relatively infant in their development to making sure that these kind of commonplace as part of a disaster risk financing approach for farmers, for organizations, for governments? Maybe you could have a first stab at that. Feel free to answer the ARC question or the broader one, Christina.
Thank you, John. Yeah, I'll take a stab at both questions from the DRC perspective. Indeed, we have navigated a realm of options for the risk transfer solution, and this is thankfully to the studies we were able to initiate before we made the decision together with the government that risk transfer is optimal. And we went through 2 rounds of feasibility studies and risk assessment studies. And the feasibility study that we did mapped all the ecosystem of partners that we could be working with and interviewed those partners. So we didn't come with a pre-made solution. We knew that we needed potentially a parametric solution because of the lack of data in DRC and at times the lack of access to collect the most up-to-date weather data. But otherwise, we were open to any setup that will include as many local actors, but also that would leverage all the capabilities we know, as you mentioned, the responding agencies, the academia, and other institutions have. So for example, ARC is in discussions with the World Bank as a potential risk taker for this solution, but we are investigating this option in the bigger picture, in the sense that the government of DRC, for example, doesn't have yet an ARC treaty. So we need to set the basis for that political agreement to then be able to sell a policy. And this is the reason why discussions are still in early days. We are also investigating, including clearly the local actors. And for that, we have initiated consultations with the local insurance companies and local reinsurance companies to make sure that everybody is on board and aware of what we want to do. They took it forward to their own insurance association to discuss the capacity that they have and the interest to participate in our risk transfer solution. And lastly, we are also investigating potentially a financial route through the central bank of DRC, if on the shorter term, this provides the coverage we need while building the capacity in the longer term. And I will also finish by saying that we have included in our interviews NGOs, international and local NGOs, that can serve as the sounding board for triggers. This is an innovative approach that we are currently using more and more in the DRF space, which is really to create a sort of consortium of actors that are present locally, but also have the experience to agree on an event happening when the numbers are maybe a bit more inconsistent. And again, due to the lack of data. I'll stop here because I guess my colleagues will also have.
Thanks, Christina. Please, Charles, Melvin, Khalile, Fatima, please do jump in if you've got an answer. I think we've got a couple of minutes, so probably just long enough to answer this question, then we'll wrap up for the day. Any thoughts on cooperation and collaboration in the area of disaster risk finance and meso and macro insurance in particular?
Yes, I think there's a lot of scope. Oh, sorry.
Go ahead, Margaret.
So I think I think there's a lot of scope. I think this is just one example of a project where we are looking to collaborate. As Christina mentioned, that there are a lot of factors to take into account. Essentially, for ARC to be involved, the government needs to have signed a treaty. But we are involved in quite a number of projects. With the World Bank, and we are confident that we'll be able to at least one of them will come to fruition very soon. Thank you.
Yes, as Melvin mentioned, we more and more we are seeing this request even from our client in West Africa to bring for more collaboration among the different development partners as part of the food system resilience program that the World Bank is supporting with at regional level in West Africa. We engage discussion with ARC, Malvern, and ARC agency on how we can think of an insurance arrangement as a backstop to the strategic regional grain reserve. I have to say the challenge is sometimes even within the bank procedures on how to make it work. And we are seeing more, but on the, I think in terms of collaborations, we identify in this process areas that is for all of us to work on together is on capacity or capacitating our stakeholder, our counterpart. This was a clear request that we received from the different stakeholders. And in our analytical work, how we can do it jointly. We see sometimes the bank doing the analytical work, then AFDB will come and do the same work. So this is one of now in Burkina, we are starting with FDV, the DRF diagnostic together to ensure that we are using the same tool and the same analytical work to inform the Burkina project on premium subsidy for ARC as part of our trophy project. So this is the type of work I have to say is pushed from donor side, but also from client side. And I think it will continue more and more, but there is really areas where we can work in, as I mentioned, capacity building, analytical work, that is really, we can do it jointly together to take advantage of the economy of scale. Over.
Thanks, Fatima. I think we're gonna have to wrap it up there. So thank you everyone for sticking with us for a bumper session today. As I said, I was very impressed by the presenters. I've learned a lot myself that I didn't know before, and the discussion was great afterwards. So thanks everyone for your time, both presenters and audience. We will have another session in mid-January. We're going to take a bit of a break for the holidays. We know that lots of other people will be too. So I hope to see you back fresh-faced after a rest in mid-January. Thanks again. Bye.